Yeah, we think they're the four banks in Australia. They're very big players, and it's a very concentrated market. So, their health is always very important. And at the moment, what we're seeing is, the banks are still the four banks are still in quite good shape. We've only had the first set of earnings come out, and the rest to follow in the next week or so. But essentially, I think the results that have come in where we're sort of expecting quite a strong first half. Assisted by tailwinds from 2022, as you mentioned, the aggressive rate hikes and impairments and bad loans still remain quite low.
Right, and that's really going to be a second half story, isn't it? Reflecting the peaking rate cycle, the higher cost of funding, impairments rising too. What then are the implications for the A+ rating amongst the big four?
Yeah, so I guess if we look at the impairments, they haven't really started to come through yet. I think our expectation is we expect to see the bad loans or impaired loans start to rise over the next half and maybe even into 2024. There's a bit of a lag effect with the rising interest rates, plus there's still a fairly large number of loans that are still to roll off fixed rates onto the higher current rate. But I think at our current thinking and base case for the banks is that, while we expect an increase in the impaired loans across the board, through mortgages and some of the business and commercial exposures, there still is relatively a strong buffer in their asset quality scores at these banks and also at the overall rating of A+. So whilst I think there's a fair amount of buffer, I think, in our thinking and assumptions at the moment that they'll be able to. It's a manageable increase in impairments, and even if it's a little bit worse than we expect, there should still be a sufficient buffer there to maintain the rating.
All right, Jack, talking about strong buffers, I got two words and a number for you, two letters and a number, CT1, Core Tier 1. How close are the big three in Australia to meeting Basel III requirements, capital ratios?
Yeah, so the capital positions are quite strong. There's a bit of flux at the moment with APRA just recently at the start of this year implementing the final Basel III rules. So we've seen a bit of an uplift. I think you would see NAB's result today from those changes. They received, I think it was 47 points uplift in CET1. And that was probably on the higher end. I think the expectation was around 40 points. So I guess we'll wait and see for the other banks if the result is similar. But I think in terms of where they're positioned, quite strong already. And I think ultimately, where we, aside from potential acquisitions and other excess capital held, I think we would expect to see the CET1 ratio settle between, I'd say, 11 to 11.5% across the four banks.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.